Hi, I'm James Robinson, and this is my stock thought of the week. So before I go any further, I just want to make a couple of comments. I continue to be 75% in cash. I've got just a few stocks that I own, and I've got all my money sitting on the sideline. And this is very hard for me. I really, really want to be investing. I really want to be finding things to buy and having them go up and making a profit. I want to be posting videos and having new people subscribe and getting new followers and putting new dots on the map for where my followers are. And I know that by not subscribing, I'm reducing the number of people that are watching my videos, the number of subscribers that I'm getting. I'm also, theoretically, at least in the short run, I think I'm reducing the income that I might be making because the market's kind of done okay since I went all cash. But at the end of the day, I continue to analyze things. I continue to believe this market is overbought. This market is too high. I continue to believe that because of Corona, the market and the economy is softer than is demonstrated or recognized by the marketplace. And so while the easiest thing for me to do would be to buy stocks, I really think it would be expensive in the long run. And I really want all of you guys to know that I would never tell you to buy a stock that I wasn't really firmly a believer in. And I'm not really firmly a believer in any stocks right now. And so even though it's less fun for me to do nothing and less fun for me to make these videos on investment theory than it is to make investment on stocks, I'm just going to keep doing what I think is right, and hopefully over time I'll get the results that continue to support people following this video and this series, and it'll get I'll get more and more followers, and it'll, in the long run, it will work out. But if many of you or some of you or any of you are also in cash and you're frustrated and you're thinking, wow, look at Tesla, or wow, look at this, or wow, look at that, I should be buying these stocks, you're not alone. It's very normal. I'll ask you to think about all of the heat that Warren Buffett is getting. He's been in cash a lot longer than I have. It's not about buying something every day, and it's not about being busy. It's about deciding what works for you and waiting until you get that pitch that you can hit out of the park, because it doesn't make any sense to be doing warning track power, right? You want to be able to hit the ball solid every time. And I just think right now you can't predict that. So I just wanted to give that comment, because I think if you're following me, you might be wondering why I'm still in cash. And it's just because I don't feel good about things. And I can't lose money I don't invest. And yeah, I can't make money. And some of you are going to make a bunch, and congratulations. But I really believe this is the right thing to be doing right now. Since I'm not giving people stocks to buy, I thought I would try and use the site, the channel, to continue to talk about what I look for in investments and what makes a good investment for me and what value investing is. So this is part 3 in my series on what value investing is, at least what it is to me. This part I've called what to look for in an investable company. Not every stock is worthy of buying, and what delineates a great stock from an average stock from a bad stock, and what do I look for when I'm buying a company? What is a value investor valuing, if you will? And so we're going to look at this from a value investor's point of view, spend some time with it. It's pretty simple stuff if you've read and studied Warren Buffett and Ben Graham and stuff, but many of you haven't. Many of you are still sort of learning those guys out and what they have, the lessons they have to teach. And my hope is that you'll watch me and go, yeah, that makes a certain amount of sense. And then you'll go find what Buffett has to say and what Munger has to say, and Manesh Prabrai and all these guys who are really, really experienced and successful, and my site will be a impetus for you to do a deep dive into those guys. The first thing that we want to talk about is that there are a series of logical motivations why you would invest in something. You would never just throw money at or throw darts at a dartboard and say, well, that's what I'm going to buy today. Or at least you ought not to. You should have a plan for when you're going to invest, and you should have things that you're looking for when you're going to invest. So we're going to talk about those sort of one by one. The first thing that you would do as an investor is you would be willing to buy something if you could pay less than the assets are worth, kind of the buying a dollar for 50 cents kind of deal. And that actually is not impossible to do. It's actually reasonably, in the right economies, it's actually pretty easy to do in something like real estate. It's also often capable, something you can do even in stocks. It used to be the case that there was tremendous opportunities to do that scattered throughout the marketplace. Now we have stock screeners, and you can set up criteria and say, I want to look at every company that's trading at below book value, for example. Book value means that the assets of the company the total assets of the company minus the total debts of the company. And you would say any company that stock is trading at less than book value, clearly that's buying, if the assets are reasonably priced on the books, that's a good deal. The story is that Ben Graham, who wrote the book Security Analysis, used to find occasionally companies that he could buy for net working capital, which meant the company had enough cash in the bank to justify its stock price. The problem is those kinds of investments don't really exist anymore. The stock screeners that are out there that are so sophisticated, if a company popped up like that, a bunch of guys would jump in and buy the stock. And so you've got to look deeper and look differently and find other ways to justify an investment other than paying less than the assets are worth. But that doesn't necessarily mean that you'll never find them. I remember hearing a story about an investor, and I think it was the owner of the Chiefs, but it was an investor from Kansas City who bought a railroad, and everybody thought he was buying a series of choo-choo trains. But what he was really buying is the tracks. And he bought the tracks because he had real estate rights of way that would crisscross the country, and he put cabling for internet and TV and everything else on these tracks because it was a very cheap way to get data transmitted around the country, and nobody else had thought of that as a strategy. And so in that case, he was buying an asset that the seller didn't know he was selling. The seller thought he was buying, train tracks, and this guy thought he was buying rights of way for other data. So those are the kinds of things you can still find as an investor, but they're harder and harder to find, and you need to have a certain level of sophistication. So we're going to assume that that's not what you're going to find, and that's not very often going to be a motivation for investing in a stock. The next logical motivation to invest is because you're buying some income stream at a logical discount. In theory, companies throw off profits. Obviously, if they don't, they almost instantly become uninvestable to me unless I'm buying the assets for less than they're worth. But assuming that I'm buying the income stream, if the company's income stream can be purchased at a price that makes sense, discounted back, then it becomes a good investment. So oftentimes when the market is going through a hardship like it was with coronavirus, everybody panics and they sell the stock because most people think they're buying numbers associated with a symbol, right? IBM at 79. They don't realize they're buying a company that generates profits, and they're buying $79 for a little slice of that company. They just see that the market's plummeting and I need to get out of this before I lose too much money. So a guy like me comes in and looks at it and says, well, this company is making this much money per share, and I can buy that share at a discount to what I think that income stream is really worth. And so that's as a value investor when I step in and buy that stock. That's also one of the reasons why I'm not ready to buy stock yet, is because I'm not finding things that I think are trading at reasonable discounts to the income stream. I think that companies are priced too high relative to the income stream, so I don't want that company. Now, if you're a different kind of investor, you will look at it and say, the stock's going up, the market's going up. If I buy it at 50 and sell it at 60, I don't care what the income stream was because I made $10 a share. Those kinds of speculative investors aren't me, and you should go find another channel. I'm going to be pretty disciplined. So the first reason I would buy a stock is because I can buy the assets for less than they're worth. The second one is I'm buying the income stream at a logical discount. Next reason why I might buy a stock is maybe the income stream is reasonably fairly priced, but the company's prospects are solid. So in the last example, buying the income stream at a discount, it almost doesn't matter what the company is. Using that theory, it almost doesn't matter how solid the company is. If I get the income stream cheap enough, I'm happy to do it. So that's buying an average company at a great price. And that's one reason to invest. And that's what really Ben Graham spent his career doing. The next issue is buying a company's prospects are solid. That's buying a great company at a fair price. I don't need to hit a home run if I'm buying Apple, right? Apple's a great company. If I can get a fair price for Apple, I'll allow the fact that I think Apple's growth is going to continue to grow for a long period of time to justify the price. So that's the other extreme, is that, and that is something that is more indicative of what Warren Buffett and Charlie Munger did than what Ben Graham did. And I'll talk more about that in other slides. But again, my third reason to buy a business is because I'm buying a business at a fair price where I think the prospects for that company are excellent. Another reason to make an investment that I think is an area of expertise that I don't think many people have, and I don't think many people consider, is either arbitrage or risk arbitrage, or sometimes merger arbitrage. So arbitrage is the idea that you can buy something on one market at one price and sell it almost instantly on some other market at a different price. And so it might be that if you found out that gold was trading for 3 cents an ounce more here than there. Here in New York than in London, you could set up a scenario where you'd go long on gold here and short on long in London, and the market would eventually adjust, and or you would, make the appropriate trade, and you could make a profit. Now, typically with arbitrage, it takes tremendous amounts of money and thus lots of leverage, and it works relatively well if you do that, but it often turns against you very quickly. Something happens, the markets don't go the way you expect, and things don't work. Another side of this, though, is risk arbitrage, and that's something Warren Buffett did a lot in his career, and especially did in bad times. And it's something that I've been looking at doing. I haven't done a lot of it in my career, but I'm looking at doing it on a couple of different companies right now. So the scenario with risk arbitrage or merger arbitrage is company A announces it's buying company B. Typically, when that happens, there's a price that's announced. I'm going to buy company B for X number of dollars a share. And to oversimplify things, we buy it all in cash. Well, what will happen almost inevitably is if the company A is buying company B for $100 a share, oftentimes you can buy company B stock before the merger at $96 a share, right? There's a gap between the price that the buyer is eventually going to pay and the price that the stock is at today. And that price is really, if you think about it, the risk that merger is not going to happen. And so if you think about that and you can start to quantify the risk that it's going to happen or not happen, you can look at the profit that you would make if it does happen, and you look at the amount of time that your money is going to be tied up, you can come up with an analysis and say, this is a good risk or it's a bad risk. It's more sophisticated than just buying stocks, but it's an option that's out there, and people don't understand that Warren Buffett did an awful lot of this early in his career, especially in down markets where he couldn't find things that he thought were going to recover quickly or do well in the short run. He could put some money into one of these risk arbitrage situations, and in 3 or 4 months the merger would close, he would get his money and be able to go on to do something else. So we may talk more and more about risk arbitrage in the future if I find one of these investments that I want to do. In the meantime, I have recently put on Twitter a great article on the thought process through risk arbitrage. So if you don't follow me on Twitter. I'll put the information up, but my handle is @robinsonstocks.com. Whenever I do a new stock pick or one of these articles, I always post it there. If I see things that I think are interesting, I'll post it there. Oftentimes it takes me time to make a video after I buy a stock, but I'll always put in real time whenever I buy or sell something on Twitter. So you can go ahead and look there for information on that risk arbitrage article that I'm talking about. The next reason somebody would buy something is speculation. The idea with speculation is that someone else will pay me more for it later. I do not buy anything on speculation, but I know that a lot of people do. I have a buddy who buys cars. Now, I would argue that his research into cars is such that he believes he's buying a car that's worth $20,000 for $15,000, going to make $5,000. But the argument could be made that a collectible car maybe doesn't have that kind of value, and it's really simply that someone else is willing to pay more for it than he is. But if I think it's likely to be speculation, I won't do it. Again, there are people who do, and there are people who are more successful than me. And if you look searching the internet, I'm sure you can find those guys, but I would never give you a speculative investment. I'm looking for investments that really are one of these four: paying less than the assets are worth, buying the income stream at a logical discount, typically for an average company where I'm getting a great price, buying a business whose prospects are solid, which is typically a great company at a fair price, and finally arbitrage or risk arbitrage, which is more risk arbitrage, which is something I'm likely to be doing in the future. So never speculation, at least for me. So I want to focus on what and this is Ben Graham, who wrote the book Security Analysis and the book Intelligent Investor, both of which you really should read. But Ben Graham was an investor in the 30s and probably the 20s, the 30s and 40s. And he was a professor at Columbia. Warren Buffett went and studied under him and learned value investing, and then went to work for him famously for a couple of years before starting his own partnership. And Warren really credits Ben Graham with most of his success in investing. And that's not completely true, because a lot of his success came from thoughts that evolved as a result of a career after that. But this is what Ben Graham would do. He would buy a fair company at a good price. He really didn't care about the quality of the company. He simply said, this company is cheap, and so I'm going to buy it. And he found the company was mostly quantitative. He would simply look at what the income stream was and either buy it with a very low PE or a very low price to book value. Oftentimes he was buying companies for less than net working capital. But basically he's looking for those kinds of things. And his idea was he would hold a stock for up to 3 years and wait for the market to come to their senses and realize that the company was worth more than they thought they were. He would have a significantly broad portfolio of lots and lots of stocks, so lots of diversification. He would occasionally engage in shareholder activism if he thought that the stock wasn't turning around and there was really, really real value tied up. He would either buy enough of the stock to control it or get together with some partners and do the same thing, and then force management to do what they needed to do. A lot of what Ben Graham did was informed by the Great Depression. He lost everything in the Great Depression, lost a bunch of investors' money, and took a lot of time to build it back. And as a result, he was very, very conservative in the way he invested. So that was what Ben Graham did, and that's, again, the way all value investors are formed by his concepts. Everybody who knows investing has heard, or most of them have heard of Warren Buffett. Less people have heard of Charlie Munger, who's Warren Buffett's sort of, he's Batman to Robin, but an intellectual genius, founded the law firm Munger Tolles, which is one of the biggest law firms in the country, made a bunch of money in real estate, had his own investment fund for a long, long time, very, very successful, very respected guy, wrote a fantastic book called Uncle Charlie's Almanac, I believe it's called, but it's a great book on how to think, not just how to invest, but how to think about problems, and it's really fascinating. But those two together, kind of bounced ideas off each other and came up with this idea of buying a great company at a fair price. And that was more Munger than Buffett. And the idea here is find a company whose value is more qualitative than quantitative. In other words, if you could buy Coca-Cola, even if you're not buying a great price for it, you're at the time, 30 years ago, you were getting a great company where good things were going to happen. If you just hold it, you're going to do great in the long run. So the idea was value versus price. Price is what you pay for a stock. Value is what you get when you buy the stock. And their attitude was, even if the price was even a little bit high, you're getting so much value in the long run that you can afford to buy this stock. They would look at consumer monopolies versus commodities. I'm going to talk more about what that means in a minute. But they believed that there were certain kinds of companies, there's certain characteristics of companies that would lead to higher value in the long run. And there were certain companies who had less likelihood to create value in the long run. And so they qualified those as consumer monopolies and commodities. They would prefer to hold something forever. There's several reasons for that. The first one is they had found these fantastic companies, so why would they ever let one go? The second one was there's friction costs to buying and selling stocks, not the least of which is taxes. And the third of which was there aren't very many of these companies, so you can't bounce in and out because there's not 50 of them to choose from. So they would look for companies, some people think you find companies with solid management so you don't need to engage in shareholder activism, and that was something that they believed in. They didn't want to get involved in leverage buyouts. They didn't want to be throwing out management. They wanted to have management who they trusted, who they believed in, because they thought that was just more conducive to sleeping well at night. They had a much less diversified portfolio, not because they wouldn't be happy owning 50 stocks, but because there weren't 50 fantastic companies out there to find. And the other thing is because they really believe that these companies are really hard to find. And so if you do find one, back up the truck, buy as much of it as you can, put everything you've got into it, because you only need a few great investments in your career. So we're sort of, hopefully you're getting a sense that I'm honing in on a couple of themes here. And one of the themes is that I want to separate the wheat from the chaff. I want to get rid of companies that are commodities unless I can buy them at a significant discount to the income stream or below the asset value. And I want to focus on consumer monopolies. I want to find companies with these characteristics that make them really good long-term value companies. We're going to talk a little bit about what those are, what a commodity company is and what a consumer monopoly is. So before I tell you the characteristics of a commodity business, I'm just give you some examples of companies that are commodity businesses without question. Airlines, gas stations, grocery stores, car manufacturers, rental cars, hotels, and credit cards. When I say credit cards, I mean, do you get your credit card from Wells Fargo, or do you get your credit card from, Capital One or from Chase? Generally speaking, those things are all pretty interchangeable to people. That's not the same thing as American Express or Visa or MasterCard, because those guys are credit card servicers, but I'm talking about the actual people that are issuing the cards. So I'm going to go through what now a commodity is, and you're going to see why each of these companies fit into that definition. So traits of a commodity business. Typically they have a low profit margin and or low inventory turnover. That's key. If you watch my videos, you'll see the very first thing that I look at is gross margins. And the reason that I do that is because I want to figure out if this thing's a commodity business. And the very first indicator of it being a commodity business is a low profit margin. The next thing you typically find, and you'll hear me talk about this a lot when I do my analysis, is they tend to have a low return on shareholders' equity. The next thing is they have virtually no brand name loyalty, and there's multiple producers of virtually the exact same product. They often have organized labor. They often have overcapacity, which means they have more inventory consistently than they can sell. The profits tend to be very unpredictable. There will be some years that the company is very, very profitable, and some years where the company is not profitable at all or even losing money. The other thing is you'll find that profitability relies almost entirely on management's ability to efficiently use resources. And one of the key components is often those resources are not within their control. So let's go through and look at this low profit margin and or low inventory turnover. So in the airlines are notoriously for low profit margins. Gas stations, again, they're not making very much per gallon. They're trying to sell lots and lots of gallons. Grocery stores, low profit margins. Car manufacturers, rental cars, hotels, credit cards. These are all there. The thing to think about is no brand name loyalty. This is the kind of thing that you can just think about intuitively and figure out if you think a company is a commodity. So in the airlines, do you really care whether you fly United or American? Or are you simply looking for the best price? With gas stations, will you drive a quarter of a mile to go to another gas station to save 2 or 3 cents a gallon? If you don't, you'll certainly recognize a lot of your friends will. Grocery stores, really what's the difference between Safeway and Fry's? A lot of women or men or people who go shopping will do it simply because of where they can get the best coupons, which will tell you how little loyalty there is to a gas station. Car manufacturers, in the aggregate, individually, some people do have loyalty. Some people are Ford guys and they're never going to buy Chevy. But in the aggregate for the community in general, most people aren't going to pay significantly more for a car in the class they want. So you're going to buy a Honda or a Toyota, and really whichever one's offering the best deal. Now you might be the kind of guy who's going to buy a Mercedes or a BMW, but the same thing. You're not going to pay 30% more for a Mercedes than a BMW or vice versa. Rental cars, again, almost anything on Kayak, rental cars, hotels, you're simply saying, I'm going to be in Dallas for 3 nights. Who's got the cheapest rate? Okay, that's a decent quality hotel. Boom, and you stay there. You wouldn't. The airlines and the hotels have tried to lock you in with these airline miles programs, and to some extent they have, but they're bribing you to get your business. It's not really loyalty to the brand. It's simply you're bought into their bribery scheme through the mile systems. Same thing with credit cards. Really, there's websites on here that you can find in the internet. Go to YouTube and type in which credit card should I get, and people will tell you, well, this one gives you a 5% back, and this one gives you 3% cash back. Apple's got a program, and at the end of the day, you don't have any loyalty. It's just giving you the best program. So that's commodity businesses, and those are not the kinds of things that I consider to be heavily investable. Traits of a consumer monopoly. So these are the kinds of companies that we want to be buying because we believe in the long run that they're going to create real profits for us on and on and on, and we won't be buying and selling and getting out of things. So those companies tend to have these characteristics. They tend to have a high profit margin and or inventory turnover. They tend to have a high return on shareholders' equity. They tend to have real sustained brand name loyalty. And that's really important because that's the kind of thing that gives you pricing power. Apple is an example of once you're an Apple guy, you're probably not going to switch very often to, you're not going to bounce back and forth between Apple and Android. Most people buy Apple and they're in the Apple ecostructure. If you're a Pepsi person or a Coke person, you tend to buy every time you go to the store, and not much is going to change. It's going to make you buy Shasta or some, generic cola. There tends to be very few producers of the same product, and you tend to dominate the marketplace. There tends to be a lack of unions. Supply is more inelastic than demand. The profits tend to be more predictable. They aren't gyrating all over the place. They tend to be hopefully going up and to the right, but generally in a pretty stable way. And you're looking for businesses that any idiot can run because sooner or later one will. These are companies that have they have a moat and they have a durable competitive advantage that will last a long time. And if somebody comes in and makes a few bad decisions, it's not going to destroy the company. So those are the kinds of things that happen in a commodity business. Now, where I'm going with this is I'm going to start going through the things that I look for, those 29 categories of a company, and explaining why I consider those things to be, those issues to be the things that help me to identify a consumer monopoly and why I value them so highly. So hopefully you'll find that interesting. But that's all I've got for today. Hopefully your investing is going well, or your patience is not driving you crazy. And we'll talk more. Thanks a lot for following.